Hello and welcome to PwC IFRS Talks, your source of all things IFRS, technical accounting matters, business issues, current standard setting and regulatory updates. I'm your host, Ruth Preedy. In today's episode, we're going to discuss IFRS 10 consolidated financial statements, and it is such a huge statement that we're actually going to divide it into two episodes. So we're going to have a part one that we're doing today, and then we'll come back to part two in the future. Joining me today in the podcast studio, I have Mary Dawson, one of our lead IFRS technical partners. Welcome back, Mary.
Hi, Ruth. Happy to be here.
So IFRS 10. So that deals with consolidated financial statements that are also effectively known as group accounts. And at a very high level, you've got a parent and his subsidiaries, and they're viewed as a single economic entity. And one of the key things that IFRS 10 covers is the concept of control. So let's start way back when, in where the story begins, Mary. When IFRS 10 was brought in, it replaces IAS 27 and SIC 12. So what were the differences?
So old IAS 27, because IAS 27 today is just about separates, right? Separate financial statements, right? So old IAS 27 was essentially the voting rights piece of literature. And it said, if you controlled entities through voting rights, you consolidated them. Right? And there was an interpretation of IAS 27 called SIC 12. And SIC 12 really talked about special purpose entities or things that weren't controlled through voting rights. And SIC 12 was a powerful weapon in the hands of a strong-minded technical partner. So somebody like me could stick a structured entity or a special purpose entity to anybody's balance sheet who had been associated with it at any point during its life, which, you know, maybe that approach had its merits. And some old school partners like me, occasionally we long for the days of SIC 12, which said, what's the right answer? Okay, you get the thing, right? But all we had was voting rights and structured entities and controls or special purpose entities. And control actually arises in a number of different ways. So when they rewrote the consolidation standard, it is mainly focused on how control arises, right? And there's a little bit at the back about, you know, how you do your consolidation, right? But that's essentially a little bit mechanical. It really does focus, the standard and the application guidance focus on, is there control?
So a one-stop shop to control.
It is. And so it touches things now that we just didn't have guidance on before. So it talks about things like delegated power. So if I've appointed somebody to act for me, that party is essentially my agent, right? It also looks at things like managed money. So if I set up an investment fund and I've got, you know, other people's money in the fund, but essentially I control all of the activities around that fund, why don't I control the fund? So it explains in what circumstances a money manager might control or not control funds under management. It also talks about de facto control, or it doesn't use that term, and it looks at things like potential voting rights.
Okay, so some of those we'll come back into it in another episode. So you mentioned there you long for SIC 12, you miss it. Is IFRS 10 an improvement?
I do think it's a better standard. It's a better standard because it actually covers the entire spectrum of circumstances in which control can arise, right? But most control decisions are so straightforward that we as technical accountants really don't stop to think about them. So if you think about any multinational or any group, it might have, I think we've got clients that've got hundreds of subsidiaries, right, distributed across the world. Nobody stops to think, does, Alphabet, Google as was, control all of its legal entity subsidiaries around the world, right? So in essence, we essentially kind of blow by that consolidation decision without really stopping to think about it because it's transparent. And an entity that's controlled through voting rights and where all of the benefits of those activities flow back to me as the interest holder meets the conditions for control, right? And control is power, so I can actually direct the activities of the entity, relevant activities of the entity. returns. So I benefit or suffer from the performance of the entity, right? And you can see the link between my power and those returns.
Okay. So what you're telling me, Mary, is normally I see an IFRS 10 question. I'm not going to lie, I run a mile because I think it scares me. But you're saying it's all easy. I don't need to worry.
99% of them are easy. The 1% are like really difficult.
That's the bit that, yeah.
And you know, they sometimes these questions are like brain melting. And you sit there with the whiteboard and some markers and a couple of smart partners. And by the end of it, you actually have a really serious headache.
Yeah, it hurts. That's why I ran away. I'll stick to IS41. Okay, so you told us there about the 3 elements in the standard. Can we go through each in turn just to get the basics before we get into the difficult bits? I think the first thing there you talked about was power.
Right. Power is basically kind of what it says on the tin. It's the ability to tell somebody what to do. Right. And if you think about, we'll go back to the subsidiary of the multinationals, you know, a subsidiary of the multinationals, whoever is running that subsidiary is going to take their direction, their instructions from parent company, the headquarters of the parent company, wherever it is, right? So the parent company demonstrates that it has its power. It appoints management. It tells management what they're going to do. So they might tell management, okay, you're, you know, offering internet services, or you're, you know, gonna assemble cars, or you're going to sell drugs, whatever it is, you know, you're going to execute my business purposes.
Okay, and those things that you've described, I think the standard calls relevant activities.
Yes.
What other relevant activities might there be?
Relevant activities broadly are the levers, the important decisions that have to be made in an entity, right? So it's, what does the entity do? Does it buy? Does it sell? Does it hold? Does it offer services? You know, does it run a corner shop? Does it run a manufacturing plant? So what it does operationally is usually a relevant activity. How is it financed? Do I borrow money? Do I have, you know, equity capital? Do I put my own, am I a founder shareholder? I put my own money in. So how it's financed, also usually a relevant activity. And strategically, where am I going? What am I going to do? You know, can I sell? Can I buy? Those are relevant activities.
Okay, so you identify the relevant activities and then you're effectively looking for the party that has power over those relevant activities.
Yes.
The other bit you mentioned was returns. So what is a return? Cash?
Cash is always nice.
Yeah. Yes, please.
But, you know, that's a realization concept, and we're actually in a recognition framework here. Right? So in the simplest example, if you own a share, right? So you own some shares as a private person. Your ability to get returns from those shares are usually twofold. You can hold them and collect dividends, right? Or you can sell them to someone else, right? So that's the simplest way in which you might get returns. So I'm, you know, the parent company, and I've got 150 operating subsidiaries around the world. So they're probably providing me with returns through dividends. They may be providing me with returns through cleverly structured transfer pricing, intercompany, interest on intercompany loans, management fees, you know, creating profits, figuring out how to get those profits back to the parent in a tax efficient way.
And does return always have to be positive?
No. Business isn't always successful. I think I read somewhere that like 9 out of 10 restaurants that open in a major city fail in a year.
Yeah.
Right? There's some horrifying statistic like that. So obviously business activity fails, companies go bankrupt.
Yeah.
And in that case, so if you had shares in the company that went bankrupt, what happened to you?
I probably would cry, run away.
Well, you lost all your money,
Yeah.
right? So you had negative returns.
Yeah.
So you invested your principal, and not only are you not getting any dividends, you can't sell your shares to anybody because they're worthless.
Yeah.
So in that case, you've absorbed negative returns.
Okay.
Returns can also be non-financial. It's harder once we're talking about sort of non-financial returns or not immediately obvious financial returns, then we start to get into the more difficult control discussions.
Okay. So what is an example of a non-financial return?
So if a big company sets up a charity to do good things in its name to maybe diffuse bad press because they're, you know, pillaging the earth or, you know, selling cigarettes or whatever it is, you know. So if they set up some charity to generate positive publicity and they control the directors, they appoint the directors of that charity, even if the charitable purpose has been established, pre-established, you know, it's got my name on it, me being the corporate, and I control, who runs that charity, and it's there to actually make me look like a good corporate citizen or make me look more like a good corporate citizen, I probably have reputational returns from that business.
Wow, so that would be definitely harder to spot than some of the more easier ones we went through. Okay, so I think that really helps go through the basics of what IFRS 10 says. So we're going to hold on tight now and get into the tricky bits. I think the first thing we talked about was relevant activities are usually obvious. But is there scenarios where actually it's quite hard to work out what the relevant activity is?
Well, it's not always. You can usually spot the relevant activities, but it's whether or not the equity holders have the ability to execute those relevant activities or change those relevant activities. So traditionally, a structured entity, like a collateralized debt obligation, for example, would be set up with a narrow and well-defined purpose, which is I'm only going to buy high-quality corporate bonds, right? And even if I am an equity holder in that entity, I probably don't have the ability to change what it can and can't do. So it can't become an internet service provider just because it wants to, just because I, as the equity holder, want it to. It must do what it was established to do. So when you've got narrow and well-defined purpose, and that purpose can't be changed by the ostensible equity holders, then you're probably into who controls the relevant activities, and maybe were the relevant activities set up such that another party actually has much more control over them than the ostensible holders of the equity instruments.
Okay, so I think in the standards you get into a discussion around what was the purpose and design of when it was set up effectively. Mm-hmm. So what are we looking out for then for purpose and design to help us work out who's got control? It sounds like it's not voting rights.
It's not voting rights. So we're looking for, I hate to say it to a degree, we back solve from benefits. So who's got benefits or who's got exposure, right? Whose business purpose does it meet, right? So I'm a pharmaceutical company and a research organization comes to me with a very clever proposal. They're going to go away and work on something for me, right? So we set up a new co, and the new co can only do research on that compound. It's got a specified period of time, and at the end of the day, the research organization can't sell the shares in that to somebody else. There will never be any dividends because it's only ever going to have expenses. It can't seek third-party funding because I, big pharmaceutical company, really want to control what's going on. So I'm going to provide all the funding. You're the research organization. You're going to do all the work, right? In that case, it's got a narrow and well-defined objective. It never expects to be like a normal business, right? To be able to grow and prosper and do different things.
Actually sell the drugs or whatever.
Yeah, exactly. Yeah. It's maybe the research organization holds the equity shares, but they can't sell them to anybody else, right? Or if they did sell them, you immediately sever the license and all of the IP, intellectual property in the new co reverts to the pharma company. So they can't really benefit from their interest holding other than they're probably there. They're going to get paid to do the research.
Okay, so that's an example where one party might have shares, but actually because of the way it was set up, they don't have control over.
Yeah. So whose business purpose at the end of the day is it benefiting, right? It's actually, in that case, it's going to benefit the pharma company because they want the drug to succeed. And if the drug succeeds, it's going to be their drug and it's going to go, it's going to be their revenue, their cost, they're going to stand behind it, their reputation, et cetera, et cetera. So it's going to essentially roll back into their bigger business and disappear.
Okay. And this is what we call structured entities.
It's a structured entity.
Okay. And is there anything else that we should make our listeners aware of if we've got a structured entity?
With the structured entity, quite often asset selection is the most important thing. So if we go back to our, we always tried to find like a genuine autopilot entity, and we've never really found one because at the beginning, somebody has to choose what assets go into my structured entity, right? So even if it's something simple as it can only buy, high quality U.S. government bonds of a specified maturity, and that's all it can ever own, right? Yeah. Somebody has to make that decision, and then somebody actually has to execute that, right? But the party who makes the decision about what it's going to own probably has a lot to say about that. Might be its only relevant activity. But in any entity, in any structured entity like that, you always have to look and see what happens if things go bad, right? So if things go badly, the U.S. government goes bankrupt, right? And they renege on all of their treasury bill obligations. What does the entity do? Who gets to decide what to do next, right? And quite often you'll see that that's not the equity interest holders or the kind of day-to-day asset manager. Quite often that will come back to the founders, right? The people who were there at the beginning, who participated in the purpose and design of the thing.
Okay. Oh, so I don't like that. We have to focus on the negative bits. What happens if everything goes wrong?
Well, to me, that's quite often the silver bullet question. If everything toddles along, as envisioned by its creators,
yeah. World's happy. It's a good place.
Things seem fine. It's the provisions that get put in place for when things go bad that really tell you who really has an interest here, whose interest is it, whose structured entity is it.
So there you go, listeners. Our biggest top tip from Mary Dodson today is look at what happens when it all goes wrong, and that's who controls.
Because what rights have I reserved for myself in an extreme situation?
Perfect, really helpful. Is there any other tips, anything else you want to tell the listeners before we close out our 20 minutes?
So we talked about relevant activities, we talked about returns. The other thing you need to see is the link between the two, right? So, in our normal operating company, I make the bold decision that despite kind of current trends in retail, I'm going to open 1,000 retail stores across the UK, right? Yeah. That is a great example of a strategic and operating decision, right? And if I have the power to do that, clearly I have relevant activities, and then I lose everybody tons of money, right? Right? So I've demonstrated that I've generated returns, in this case, negative returns from that activity, right? So really you need to have all three. You need to have power, you need to have benefit, and you need to see that your power actually essentially it's a lever that your power actually over the relevant activities, it's the relevant activities are the lever that create returns or destroy returns.
Okay, perfect. So we need the power, the return, and the link between the two.
Yes.
Okay, so I think that's brought us to the end of our 20 minutes, but don't worry everyone, Mary will be back for part 2, where we get into the exciting things like potential voting rights and what is de facto control. I can barely contain myself. So please do listen in for our next step in IFRS 10. But what we covered today was some of the basics of IFRS 10, what is control, and then we looked at where you might see a structured entity. And remember, look out for what happens when it all goes bad. If you want more information about anything we've discussed today, please look at our website at www.pwc.com/IFRS. I hope you've enjoyed today's episode. I'm your host, Ruth Preedy. Happy accounting. The preceding programme was brought to you by PricewaterhouseCoopers LLP. This content is for general information purposes and is not a substitute for consultation with professional advisors.